Yeah. I think so, because the blue lights off. Wait, no, it's good, it's good. It's on.
Is Sarah online or no? No.
Oh, oh, great. Whatever. Okay, you're live.
Live? All right, welcome. This is the Board of Finance meeting for January 17th, 2024. First item on the agenda is call to order. We have myself, Chairman Mike Anderson, Dan Smith, Vice Chair, Gary Anino, Carl Johnson, Lou Gingerella, and Amy Friend here is alternate secretary. Winona Burdine is online. And we'll seat you, Winona, for now for Sarah.
Okay, thank you.
Move on to public comments. Any public comment while we start here? Anyone online with a hand up? Okay, you can move on to correspondence. We got some updated financials from is it Tim that's over at whoever's in charge for Board of Education? I don't think that these December ones have been accepted by the Board of Education yet. I think they were supposed to do that on the 27th or something like that, but everyone get those, but they got the non-lasting account and everything in there. We're not going to discuss these, just make sure you have them. We'll probably, when the Board of Ed comes in, we'll, if you have questions about it, I mean, there's, I certainly have a couple of questions, but we'll address that when we have someone from the Board of Ed here, officially. And the other one was the auditors did send out a letter to us. I sent that to you guys. I mean, we should be in good shape. They're supposed to be here tonight. Are they on? Okay. Okay, great. So with that, we'll go on to agenda item number 4, the audit presentation by King and Associates.
How's everybody doing tonight?
Just for the record, it's Sean O'Grady for King. Thanks, Sean.
Thank you. Can you guys hear me okay?
Yes, we do.
Okay. And I'm joined with Jessica as well.
Hi, Jessica.
Hey, everyone.
Is it possible to get screen sharing privilege?
Brett's working on it.
I'm
Stand
working
by,
on
Sean.
it. Stand by.
Okay, no problem.
I had to do this one before. Why won't it share?
It looks like it's working.
He's got it.
Okay.
All right, we can see it. We're all set.
Okay. Okay, so I have a couple slides. The slides have page numbers, so it'll reference back to the financial statements if at a later time anybody wanted to go back and see what the slide is talking about. After the meeting, I'll email Susan the slides so that everybody has them. And then I've also got the PDF of the audit reports, so I'll flip back and forth as we go through it. And if there's any questions, just jump in and stop me anywhere along the way. So the audit, it's made up of 4 parts. You have your financial statement audit, your state single audit when you spend 300,000 of state money, your federal single audit when you spend 750,000 of federal money, and you have the Board of Education's EFS procedures that the State Department of Education requires us to perform each year. So this is it's indexed to the audit report. So you have your independent auditor's report on the first few pages, management's discussion and analysis on pages 4 to 10. It's a high level overview of the changes between year to year. Pages 11 to 46, you have the basic financial statements and the notes. Pages 47 to 49 are the required supplementary information. It's trend information for the pension and OPEB. And then following that, you have some other supplemental schedules on pages 50 to 67. Let's flip through here. Pages 1 to 3, like I said before, it's the auditor's report. You guys received a clean opinion, which is what you're looking for each year. Pages 4 through 10 here is management's discussion and analysis. Gives management a chance to discuss reasons for changes during the year, things that impact future years, talk about purchases of capital assets, changes in long-term liabilities. Pages 11 and 12, these are government-wide financial statement pages. These two are prepared on the full accrual basis of accounting. So these include all of your capital assets and your long-term debt. The first page we're going to look at is 13. The full accrual is kind of too broad. It doesn't really give you it's tough to look at, I guess. So page 13. Page 13, this is your fund basis financial statements. So these are prepared on the modified accrual basis of accounting. These focus more on near-term inflows and outflows. So these pages exclude any capital assets and long-term liabilities. Pages 14 and 16, these two pages, these reconcile the numbers from the fund financials on pages 13 and 15 here back to the full accrual pages. So starting on page 13 here, your general fund total fund balance was 4.5 million. The components can be seen later on in the audit report on page 34. So they show up in the chart here. Most of your general fund is unassigned. GFOA recommends keeping 2 months of annual revenues in surplus, about 16.67%. Your general fund total fund balance is about 21% of your annual budget revenues. So you're doing better than GFOA recommends.
Sean, what was that percentage again, the recommended?
So they recommend 2 months, which turns out to be 16.67%.
Okay.
Going to page 15. So this is the statement of revenues, expenditures, and changes in fund balance for your governmental funds. During the year, your general fund showed a net change in fund balance of 110,000. The school modernization project fund. So you can see the grant payment received here of 866,000. That brings the deficit in the fund down to 1.1 million. So it was almost 2 million. Now it's down to 1.1. On page 18 and 19, so you'll see a column here that wasn't there last year, this custodial funds column. While we were out for field work, we stumbled across some bank statements for the cemetery funds, and we had them checked, and they do have the town's ID number on them, so they should be reported in here, even though they are held for the cemetery funds. So a lot of places like to see some charts and tables. So we have a couple in here. We have a 3-year general fund balance trend chart. So you can kind of see how your fund balance is trending over the last 3 years. A little bump up 21 to 22, and then a slight increase 22 to 23. The components other than unassigned are relatively small, so you can't really see much change in there. And then the second chart, these are some other towns similar to you in size. Valentino's a little smaller. So it's comparing unassigned general fund balance as well as total general fund balance as a percentage of the budgeted expenditures, just so you can kind of see where other towns are keeping their fund balance percentages at. So we have yours in the first column here. Columbia, the 22 numbers, 23 is not yet done. So your unassigned is pretty similar to theirs. Theirs a little bit higher. Preston's 22. Yours is pretty similar to theirs as well. Salem's is a little bit higher. I think theirs is higher than we would normally see. And Valentine's at 15%, which is just a little bit less than yours. Starting on page 20, we have the notes to the financial statements. The first few pages, it's pretty boilerplate. There could be slight modifications just for like town specific things. So the major funds are listed here. Capitalization thresholds set by the town. And then we get to page 26. So this is a reconciliation between your budgetary basis to your GAAP basis, which would be page 15. The budgetary basis is probably what you're more familiar with looking at your board meetings. And then we have differences between the two, such as the on behalf payments for the state teachers retirement and OPEB. The amount the state kicks in for you in the fund financial statements, it gets grossed up as a revenue and an expenditure to show the full picture. And then you also have adjustments for encumbrances, which it's kind of like a timing difference. So when the purchase order is issued, it shows up in your budget, but it's not truly a liability yet for GAAP basis. So there's kind of a delay when the expense is recognized. The next notes that are significant. So you have your leases receivable. Right now you have 3 big leases. Pages 29 and 30 kind of show you balances along with future payments to be received. So you can kind of see what you're going to be receiving over the years. On page 32, so here you have your long-term liabilities. Your current year pay down of your general obligation bonds about 717,000. And you're looking at debt service payments of about 1.4 million for at least the next 5 years. And then in the chart here, it groups it into groups of 5 afterwards. So coming to page 34, I'm sure everyone's aware, but you paid off your bond anticipation note of 1.8 million during the year. This included interest of 46,000. The next few pages, these talk about your retirement benefits. Some of the things we like to point out: the liability associated with the town for the teacher's retirement, even though you're not responsible for it. It's possible somewhere down the line the state could push some portion of this to you. Your liability at June 30, 23, it was 27,162,433. The state also kicked in on your behalf. Where did it go? 2.6 million or 2.1 million. The 2.6 million is the government-wide recognized number for the pension expense. And similar with the teacher's retirement OPEB, The liability associated with you guys is about 2.4 million, and the state kicked in 30,000 on your behalf for that. Going to page 45. So we have the upcoming pronouncements. These first two likely won't have much impact for you. GASB 101, the compensated absences, that one could have an impact. It doesn't go into effect until your fiscal year 2025. So that one's still a couple of years out. Page 46, we have a little note on the restatement, just showing that the cemetery bank accounts were picked up in the custodial funds. They totaled about $18,000. Pages 47, 48, and 49. These are the trend information for the pension and the OPEB. It just kind of shows liabilities over the last 10 years. So right now there's only 5 on record, but once it gets to 10, it'll show 10 each year. Pages 50 through 56. Here you have your detailed budgetary statement. So this is probably what you're very familiar with looking at. You can see where the variances are, any appropriations and fund balance. Don't know if there's anything significant. Starting on page 57, you have your non-major governmental funds. These funds don't meet the criteria to be qualified as a major fund. Major funds are required to be shown in front up on pages 13 and 15 next to the general fund. These funds are smaller and they're aggregated together. Pages 63 and 64. These are supplemental schedules. These aren't required, but they show changes in fund balances for certain projects, beginning balances, transfers in any current year expenditures or other revenues. And the fund balances will tie back to the capital non-recurring or the capital projects fund. Page 66, you have your tax collectors report. So this will show outstanding taxes receivable. Let's get to it. By grand list year. One of the things we look at in our ratio analysis, we like to compare the outstanding receivable balance of all your grand list years to your current levy, and compare that to other factors that we know. Yours was roughly 4.1% of the current levy. The ratio we normally see would be between like 2 and 6 to 8%. So you're in the good range. So that would bring us to the end of the main package. Jess is going to take us through the 2 single audit reports. Does anybody have any questions on the main audit?
I don't see any, Sean. We can go ahead with the
Okay, thanks.
addition from Jessica.
On the state single audit, page 6. Expenditures that were spent with state money totaled 4.8 million. 2.6 million was ECS, which is educational cost, and the excess cost. 239,000 was town aid road. 104,000 was from municipal revenue sharing, and then there was also 800K from McCall and 866 from the school construction reimbursement. And then on page 8 and 9, is a summary of the auditor's results, and there was no material weaknesses or significant deficiencies reported, and no non-compliance with major grant programs reported. The major programs that were tested this year were Towning Road and Pilot.
So here's the schedule that she was referencing. It shows up inside of the state single audit package, and it's on page 6. It's hard to screen share the PowerPoint and the audit at the same time. And then page 8, the chart shows no material weaknesses, no significant deficiencies identified, no non-compliance material, and then no internal control over major programs, material weakness or significant deficiencies identified. And then the chart down here at the bottom shows the major programs, the Towning Road and the tiered pilot.
So the federal single audit, which is a separate packet on page 6 and 7, there was 1.8 million spent with federal money. 138,000 was from school nutrition, 505 was education related, and 1.165 was ARPA related. On page 9, the summary of auditors' results, there was no material weaknesses or significant deficiencies reported, no non-compliance with major grant programs reported, and then ARPA was the major program that was tested.
And the same thing, just to show you the schedule in the federal package. So you have 2 pages here, and it shows it broken down by grant pass-through ID number, and then the total amount spent per grant. So you can see that the ARPA was the biggest one this year. That's how it ended up getting selected for testing. And then again, the chart, no material weakness, no significant deficiencies, no non-compliance material, the financial statements, and then on the major programs selected, no internal control weaknesses for material weakness or significant deficiencies. And then you can see in the chart below that the program that was the major program. And so then after that, we come to like findings, recommendations. We had a few management letter findings last year, which we review and follow up on in the following year, which was this year. So last year, we recommended the town adopt a policy and procedure manual. This was corrected in 2023. The town created the manual and it's been adopted. Last year, the town and the Board of Education's reconciliation of expenditures, there was an issue. So we recommended they revamp their procedures, strengthen them, and come up with a better way of reconciling their numbers. It appears it has been corrected, as there was only a small immaterial number that it was off by. I wrote it down, about 11,000. So it could be related to timing, a payable that was shown on the Board of Ed side that doesn't get cut until the following year for the town. So that's a small amount that we deem insignificant. And then last year, this was just an oversight. The rate bill and the tax warrant, it never ended up getting signed. So we checked this year's one and it was signed. I guess, does anyone else have any questions on any of the packages?
No, I'm glad to hear that, your recommendations, because that was going to be my question. I know there was some reconciliation stuff that you were concerned about Board of Ed, and so you feel like they've corrected it to a large degree?
Yeah, so the issue was kind of like between the town and the Board of Ed working together to balance their 2 books to each other.
Right.
And I think they've worked out a process that they've been working on to get that done.
Good. So I think from all, they should tell us we have a clean audit and there's no material issues that you came across, correct?
Yeah, yeah, you guys are in good shape from what we can see. Uh, it would have been filed on time last month, but you guys didn't have the meeting. So audits filed on time was about 33% of the state, I think. So you kind of fall right in that mix. We won't count that we waited till the next meeting.
Any questions from the board or I'll, at this time, what time is it? 7:26. Sarah, you can be seated. Thank you, Winona, for sitting in. So you may. This is Sean Murphy, our treasurer.
Good evening. Sean Murphy, Town Treasurer. I just had a couple of questions. You mentioned the standard operating procedures or whatever that the town did. Did the Board of Ed fulfill that obligation as well?
Were you asking about a Board of Ed manual?
Yes. Did the Board of Ed fulfill the requirement for the standard operating procedures that you referred to as being a discrepancy in the last audit?
Let me check.
Is that something you want to get back to me on, or?
Yeah, I was just going to tell you, let me scroll through all the permanent files I have. For some reason, we didn't mark it down again, but I want to double check it for you.
And another question I have is concerning a lot of times, problem areas, one of the problem areas that towns, schools have are the school activity funds. To what degree were those audited at all? And
Yeah,
to what-
we usually do extended testing on the student activity funds just because they're high risk areas with the amount of cash that gets handled. I can scroll and see what.
would you recognize any misuse of student activity funds if they, in your type of audit you do on those?
So when we look at them, we're looking to make sure that there's a receipt or an invoice for what is purchased and that somebody has approved that bill. So then if somebody's approving like a fraudulent receipt, we may not notice that, but that's not likely to be happening.
Okay, thank you. And one more comment is somewhere in the audit, sorry, I couldn't find the page number, but it recognizes a CD that was taken out during the fiscal year. and it listed as a less than 12-month CD. And technically it's a 12-month CD versus less than 12 months.
Yeah.
I'm sorry, I didn't get the page number. I don't know where that would be.
Yeah, I was just looking for it. It's on page 28. Yeah, so I guess it falls right on the uh border. It depends on when was the 1 year taken out. I can go back and look, but
April.
so as of June 30, it would be like less than 1 year to maturity.
That's where that came from. Okay. Thank you very much.
Mhm.
Any other questions from the board? Go ahead, Lou.
I just have a couple of questions on format. Are these financial statements available in Excel spreadsheets?
Yeah, I could send them to you in Excel.
And you had mentioned ratios that when you were comparing us to other towns.
Hmm.
Is there a list of ratios that you use in your analysis of the financial statements besides just that one that you listed or mentioned?
We don't maintain a list, but I work on a lot of towns, so as I'm going through it, I know where the ratios are because I see them across the towns.
So there isn't like a list of ratios that are typically utilized in analyzing the financial statements or auditing the financial statements.
No, I don't have like a standardized list. It's just kind of like area by area. So like, as you determine like a ratio may be good in this situation, you'll implement it.
So there isn't an industry standard publication type? Like an
No,
RMA, like an RMA? Okay.
no, for the tax collectors, I'm going by like experience across all the towns I've seen.
Okay, thank you. Okay.
Any other questions? Entertain a motion to accept the audit as presented. Second. I guess I made the motion again. Just make the motion. And somebody else will second.
Okay. Make the motion to accept the audit report as read.
Any further discussion? All those in favor say aye. Aye. Any opposed? Any abstentions?
Mike, I'm gonna abstain because I only caught the last half of the presentation.
Okay. Five zero one. Sarah abstaining. Okay, thank you so much.
Okay, thank you for having us.
Thank you.
Number 5, we have Daryl, come on up and tell us what you got.
I'll start out by saying we're solvent. If you take a look at the summary page that I gave everyone. Real estate went up 1.18%. Motor vehicles, if you remember last year during COVID, used motor vehicles took a tremendous increase.
Yeah.
Well,
Remember.
You give it back. Okay, so used motor vehicles are now back to where they should have been all along. Consequently, that affects our grand list because the value of used vehicles came down. So we lost about 3.79% or about $2.6 million in the down direction, which is quite a bit. If you look at personal property, we're up 27.23%. Majority of that came from the solar farm on Providence New London Turnpike, that new 10 megawatt or eight, I guess it's about 8 megawatts now, because they reduced the scope of the project. Still, $10 million, about 7 million in assessment, so not bad. And we're collecting on the Ella Wheeler Solar Project. They're giving us, that's the, where we made a contract with them to give us $102,000 a year with an escalation clause. They're starting to pay us. So that's going, that doesn't show up in the grand list, but we're getting $100,000 a year there. And of course, total grand list went up 2.74%, almost 2.75%. Or in dollars, about $500,000 more to spend, roughly. Excuse me? The numbers, from where? It's on the sheet that yeah, 2.74% increase in the total grand list.
But he said it's equating to about $500,000
$500,000 in spendable money.
in, yeah, extra,
on the mill rate.
right.
So not bad. We're a small town, and that doesn't reflect some of the houses. A lot of people are saying houses like on Wildflower, a couple of them on not Winnetou, Wyesop Road. People look at that big one that's going up. Those weren't finished October 1st. We got more to come. So we ought to have a good year next year.
Okay.
Yes.
And I don't know if it's appropriate or the right topic here. There was some kind of discussion about the solar field increasing over a threshold and therefore, or you looking at it as 2 versus 1. and- Has that been resolved?
That's a project. It's on Boombridge Road on the Lewis Farm.
Yep.
We're in court,
Okay.
okay? There's another couple of towns also have the same issue, so we'll find out what's gonna happen. What they did was, when they went and got approval, they were approved for a 5 megawatt project.
Yep.
Statute says if you're 2 megawatts or less, and you're in this agreement to sell power to state universities, that you can become tax exempt.
Right.
Well, that's not what they applied for.
Right.
And then after the fact, when they found out, they said, oh, we're now splitting the units up. Well, if you go up there, you can't tell where the split is.
Right. Right.
I mean, it's all together. It's just that they kind of gave it the blessing and said it's now 2, 2, and 1.
Yeah. Yeah.
Well, we're in court.
So are we, so is there a potential bad guy on the horizon if we are not successful from that?
We'll lose some money.
Yeah.
I mean, then we got this, like I said, this project now at 450 Providence New London Turnpike.
Mhm.
We're taking in somewhere around $7 million new assessment. What happens if they take that 8 and they say now we're 1111111
Right.
and we don't pay you?
Okay.
So the state legislature's got to get into this.
All right. Thank you. Sorry. I didn't mean to take you
No,
off
no,
that.
No, I was thinking the same thing, Gary, so it's a good call.
it's a true issue because, you know, when the state legislature gave this law, or they never recognized it to take these large solar fields and people splitting them up. Their idea was these small 1 megawatt solar farms on somebody's back of a farm or something like that. And that would be exempt, and that would have a minimal impact to towns. Well, there's solar fields all over now, southeastern Connecticut. I mean, every town will take a hit. And it's not fair. You know, it's not like they're losing money. So they're trying it, you know, they decided that they're gonna test the waters. although they did file the right numbers, so, you know, they didn't want a 25% penalty for not filing.
Well, thank you very much. And
But it's something to watch. We're watching it. We have an attorney. You know, Rob Levine is our attorney on the project.
Daryl,
Yes.
just what you just said, that they filed the right numbers for this year, so they wouldn't do the 25% penalty.
Yeah.
If they get approved, do we have to pay them back?
Court will decide.
Okay,
They haven't paid us, so they won't be paying us back.
yeah, but we'll.
They haven't paid us.
They haven't paid us, okay. So as soon as they pay us and they have decided that that's what
Well,
they're gonna
they're
do,
now incurring interest at 1.5% month,
okay. All right, thank you.
all right?
Yep.
So, but they decided still to roll the dice and not pay us. So we haven't collected anything, so we won't have to give them anything back.
just one, Sean, give me a second. Winona, do you have your hand up?
Yeah, thank you. So I realized that the revenue is up 500,000, but I was wondering if we could get the actual number, the full number.
Don't know the mill rate. You're gonna have to know a mill rate before we can calculate the exact increase in revenue.
No, I meant, is it like literally 500,000 or is it, is
Use
it
the
like,
mill rate, 28.99 is what we're at right now.
yeah,
Yeah, we're at 28.99, and we have an increase in assessment of, what, $16 million. So
16,630,
Hang on.
822.
you want an exact number. 16,630.
yeah, I apologize. We just don't have the handout online, so.
$482,113.
482, 113.
Yep. At the current mill rate.
Thank you.
But we
Sean?
always raised the mill rate a little bit, so I assumed that we was gonna get about $500,000.
You make Gary very upset going with that assumption.
Not always? Okay.
We did push it down once, just a little tiny.
Go ahead, Sean.
I guess this is a comment and then a question. You mentioned the solar farm on Ella Wheeler Road. A comment why that's not included in the tax numbers. The selectmen approved a payment in lieu of taxes for a period of time with built-in increases.
20 years.
20 years. I'm not sure how much we increased it every year. Don't recall.
Few percent.
But does that not show up on in our budget then as a different revenue
Yeah,
line?
it's somewhere else. It's not,
Okay.
it's not my grand list.
Yeah, I would imagine it's going to be a different revenue line item.
Probably obviously in the revenue side of the budget coming in.
But it's still money.
It's 100,000, you said?
It's 102,000 this year, and probably I think it's gonna be 105 or something like that. I think it's like 3%.
You know, the developer at the time, they probably sold it a couple times.
They have.
But basically, the only way the project would work, we were told, is whether they could negotiate a certain, term
Yeah,
contract.
and the tribe held a gun to our head in that they were gonna take all the land. They were paying full rate taxes and they were gonna put it in forestry.
Correct. That's
And
why.
That was about $500,000
We
hit.
could, if they would have put it in forestry, we would have lost all of it.
Yeah,
So
I mean, so it's more than $101,000 because you have to look at what the results would be.
But doesn't the approach to try to make it tax exempt violate the pilot program? Or has our attorneys looked at that?
He's looked at all of it.
So we're not protected from this approach to make it tax exempt?
It's in court. That's all I
Okay.
can say. I mean,
Okay.
you know, the issues are more complicated than face value.
Yep, all right. Thanks.
Daryl, you have any idea how many acres or whatever that the tribe could put into farmland and what we would be, what would we be out if they did so?
Oh, God, it's in the millions. It's huge. You don't want to make the tribe unhappy right now.
Go ahead, Lou.
The agreement that you just referenced, do we have other agreements like that?
No,
The auditors referenced that we had some lease receivables.
I think that's having to do with.
That's the water company, the school, and Bon Appetito.
we are leasing some land
We-
in Bon Appetito.
Yeah, and we lease, as far as receivables are concerned, Lou?
Yeah, Bon Appetit.
Hmm?
Bon Appetit is on our land. We own that building. Well, he thinks he owns it, but it's on our land.
Okay, I just wanted to clarify if there were any other agreements
Yeah,
like
there's
that,
there's other
but that's different.
different.
Okay.
Kara, did you have a question? So we're solid on this, Daryl?
We're solid.
Awesome.
Go spend some money.
Well, we appreciate it, you know, and I know you've been going through some tough times with your
Huh?
family. We just appreciate all the hard work, you know, given what's going on with your wife, and we give you, you know, we think that
Yeah,
we hope the best for you and
thank you.
we appreciate all the hard work. All right.
We'll be mailing out increase notices to people that deserve them.
All right, on to item number 6, selectmen presentation of a 20-year capital plan.
So
Yep, it's on.
before I pass this out, just a little background, I'm gonna give you each a copy. I did it 2 ways, so I'm giving you back the 5-year plan as well as a 20-year plan. Did the 20-year plan 2 ways, did it with a bonding option, without a bonding option. Just to give you an idea, this is out of my lane typically to do this. It's not perfect, but it's gonna give you a good idea of what it might look like. It's all, when you get past 2 or 3 years, it's just a plan in a roadway anyway. There's always a living document that you can work on to change, but after going through this, there's 4 things you can do with a capital item, right? So you can bond it, you can finance it, you can save to buy it at a later date, or you can do nothing. And that's our 4 options anytime we have a capital project. And in the past, we've done a lot of option number 4. So now we're looking at which of the other 3 options work best. And in this plan, I've got, on the one we did some bonding, I've got a combination of bonding, we've got some financing, and I've got some saving, because things we started saving for, we're still saving for, like covering up the bulky waste pile and things like that. The one thing I will say that about this, going through this exercise, and I'm kind of glad you asked me to do it, as much as it was a big pain to do this. I mean, I know, and Sarah, I'm sorry you don't have a copy, but I finished the new revision at 4:45 tonight, so there was no way to get this to you. We went over this for about an hour and a half last night at the Board of Selectmen meeting. There was some things I was able to change at their suggestion. One was on the ladder truck. If we were to buy a new ladder truck, we were told that it would take 4 years to come in, and I had the bond starting next year. So why start a bond and pay interest for 4 years if the truck's not going to be in for 4 years? So I pushed that back. And by doing that, I pushed back the truck that was going to come after that first 10 years. So basically what this is on the bonding packages, it's only affects the fire company. And it's basically, it was 3 10-year sections of bonding to get 2 trucks, 2 trucks, 2 trucks. So at the end of 30 years, the oldest truck is 30 years old. And then, and the newest truck is 10 years old at the end of 30 years. I thought it was going to take down the overall budget more. It did accomplish one thing. It gave me more of a straight line across. As you're going to get the without the bonding also, where we have more of this effect, highs and lows. We go from 400,000 on one time to 1.3 million in another year, depending, doing it the way we're doing it now. If we were to buy these trucks when they're asked for. But by doing the bonding, it creates a more of a steady flow of maybe, between 600 and 800, we'll say. The number's higher than where I think the appetite for the town is, being in that 800 range. However, I also went with worst case scenario. I did 5% interest across the board, which we're hoping that it won't always be 5. It's 5 now. We could, if we get back in that 2.5, 2 3/4 range where we were before, 3. So that would take it down quite a bit. But right now I would live with 5 because I think I wanted to show you what, again, worst case scenario. If you get down to 3%, then some of those that are in the 800 range drop down to the low 700s. So let me pass this out to you. You're all going to get multiple copies, and then we can just go through it a little bit. The outcome is this is what I think the outcome is, and I talked to Brett and Nicole about this last night. I think it would behoove, since we're not going to do this year, we have already presented you a 5-year plan, which we only really voted on the first year. It's a 5-year plan, but it's the first year we approved to send you. I think it was $638,426, something like that. Actually, I can tell you exactly what it was. $638,436. That's what we sent forward to you for you to look at and see if that's something that you think might fly. In that, there's leasing with the highway department. There's leasing on the ambulance. Highway, all their vehicles are leased over a 4-year period. At the end of 12 years, you would have 9 new vehicles, and no truck would be more than 12 years old. But out of the outcome of this is we thought maybe the best thing to do would be after this budget season and well before the next budget season, so maybe starting in May or June, put together a small task force of maybe 2 members of the Board of Finance, 1 Board of Selectmen, and 2 members of the Board of Ed, and really identify which of those 4 ways to address capital makes sense. And maybe it's a combination of all 4. Maybe sometimes you do nothing. But this is going to give you a guide of how it looks when you do it different ways. But I think that maybe a task force of 5 or 6 people coming back maybe on the next year September tri-board meeting and say, this is what we came up with. And how does the tri-board, do they agree to this or not? How does the Board of Finance think of this plan? But it's a lot easier to get 3 or 4. I know myself, you, Michael, and Steph Mastriani are going to get together next week to start talking about what's school capital and what's town capital. But maybe a bigger picture is, how do we address capital? Do we address it through bonding? Do we address it through financing, through savings? And what's the positive and what's the negative of each method of doing that? Obviously, bonding ties up large amounts of money for a period of time. Savings is great, except that at the end of it, the vehicle may cost more than when you started saving for it. And of course, financing is you're paying extra money. So let me pass this out, and then we'll go through it a little bit, and then if you have any questions, we can go from there.
So Bob, Nicole, and Brett, thanks for doing this. Before we even see it, I know this is a ginormous pain in the rear end, but without looking this far down the road, and we know it's a guess after 2 or 3 years, if you don't start thinking about these big blips that are coming, then we have no way to adapt to them.
Gary, I put this to an exercise. We never really dug into this deeply before. On this sheet, it'll either say with or without bonding. Okay, so let's start with the without bonding categories, first of all. So basically, the top two sheets, the blue and white sheets, are the five-year capital plan that we talked to you about earlier. Nothing's changed on this, because this is what we already talked about. So that first year, the 638,436 is where we are. But what does that include? It includes the 3 trucks for the highway garage, if we're gonna use financing and go on a 3 or 4 year cycle to buy new vehicles. It also includes the ambulance. So the ambulance wants to do a van ambulance and a box ambulance. The van ambulance would be the first one they got. It's the less expensive of the two. So the ambulances you can get 10 years out of an ambulance. If you do it on a 5-year cycle, they buy the first one over a 5-year financing for 5 years. At the end of 5 years, that gets paid off. They buy the box truck and so on. If you find down the road that that's too aggressive, that you could stretch these out for, or maybe go 2 years without buying a new ambulance in between, that's fine. The other thing is on the highway garage, as we talk about financing trucks, doing 9 trucks, I only did trucks that were more than $100,000. If you did 3 trucks over a 3 to 4 year period, in 12 years, you've got a new fleet, then maybe the town says, you know what, we can do one of 2 things. Either change it to a 16-year plan instead of a 12-year plan and only buy 2 trucks a year. Or at the end of the 12 years, go for no buying of trucks moratorium for 4 years or 5 years, unless something really drastic happens to one of the vehicles. But it gives you options. And I thought that's why a task force looking at capital could look at that and say, what makes more sense? Should we just buy 2 trucks a year and spread it over 16 years? And, or should we just buy 3 trucks, spread it over 12 years, and then go for a moratorium for 4 or 5 years without purchasing any trucks? I'll be honest with you, 12 years is not an old vehicle these days. So, although there is a lot of wear and tear on these vehicles, but if we can take care of them, maintain them, but you'll see when we get to the regular budget, the maintenance numbers keep going up and up because we have an old fleet on the highway garage, and that number's getting bigger each year, as I think Alan mentioned the last time he was at our meeting. So that's what I did on the non-bonding. So you see, if you look at the bottom line, the 3rd page, it's got yellow, green, and blue. It shows you a truck. Let's say the truck in yellow. When it gets paid off, another truck starts in yellow. And then when that gets paid off, another truck starts in yellow. Same thing with the green, and same thing with the brown. So each time a truck ended, another one would start. The thing with, that's the top half of that page. The very bottom is a combination of all our budget numbers. So the very bottom line, so line number 63, it's in brown. You look and see the peaks and valleys of that process. So the first year we're starting at, it's like 638, 435.88, which is a 638, 436, and then jumps up to 998. It goes to 900 again, then 1,000,003, then 800, goes down to 500 and change, stays there for a little while, goes up to 700, then 1,000,003, then 1,000,004. And you can see how it has the peaks and valleys because we're buying on demand. We're not buying, we don't have a plan. It's just someone says we need it, we fight with them, we push it back a year or 2, then we buy it, and it costs a lot of money. So that's that plan. You'll see when we talk about the bonding plan, how that changes a bit. Again, my only disappointment was the bonding plan did not come up with a steady number lower than I had hoped. And again, that could have something to do with the interest rate, also the number of years that we bond for. So if we want to just switch over to the plan with bonding, and this is something you can, go ahead, Gary.
Just a quick question. How do you define, how do you decide on what rate to use? I mean, what do,
So I just used,
as a municipality, do we get a better rate?
oh, sure we do.
Yeah.
Myself and Sean were talking about today about a different project, about using ADA and what kind of pricing you would get.
Yep.
But I think trying to use a worst case scenario.
So
I'm
you
just
took
giving
a
you
conservative
picture,
approach.
right? Yeah,
Yeah.
exactly. To say that we know in 2 years we'll be down to 3% again, I don't know that. We don't know that. We know that hopefully inflation will drop a bit, interest rates will drop. But there's not a guarantee for those things to happen. Also, when I'm doing I was looking, I was trying to guesstimate at what a vehicle is gonna cost 15 years from now also. On the ambulances, we were buying I was buying the van ambulance at around 150,000 because that's what the ambulance said. The other one would be 250, but is it really 250 or is it gonna be closer to 350, 10 years from now? So I bumped it up 50,000 a year over 5 years, which is $250,000 more in case the ambulance is that much more than it is today. So again, this is a conservative view. Everything would come in a little bit lower than this, but I'd rather do that than,
Yeah.
I won't be here to explain it, but someone's gonna have to explain why it's so much higher than we said it was gonna be in 2024.
Now, when your finance director role gets filled, maybe somebody is a little more savvy with Excel can build in where you can load the prices for the vehicles now or whatever, and then put a standard escalation in for the spreadsheet. And it just throws it out
Well, see,
there.
that's the other thing. I got a spreadsheet from the highway garage and a spreadsheet from the fire company.
Isn't it
I
great?
integrated them.
Yeah,
So and that means I had to do everything manually.
Yes.
They wouldn't work together.
Right.
So everything that got added on a calculator, edited, and then, yeah, that's how it works.
as we get better at this, and I'm sure we will.
I'm not gonna get much better.
No.
But it's not my
There'll
job.
be there'll be a standard template that'll be directly importable and be able to build one spreadsheet. I'm looking, Winona's, she's trying to stay with us because she could tell we're running with scissors right
Well, I
now.
know if this is the last time I do this, I'll be really happy with that, so. Then with the bonding, if we could just look at the last page to start, that same line at the bottom. And you'll see how it didn't go from 500 and change to the 1,000,004. Instead, it kind of stayed steady at the 823, 773, 747, 749, 866, 901. When it did jump into the nines, if you look at it, it's because either the chief added in an $80,000 pickup truck or the highway garage added in, $100,000 for a skid steer or whatever happens to be. It skewed it. But when those things weren't being added in as additional items, it stayed pretty steadily in that $700,000 range. So I guess the positive thing about bonding is at least it gives you a steadier, you can come into a budget meeting knowing that, okay, we're probably gonna have to spend between X and X. I know when Darrell was here and he said that $500,000 increase in the grand list, but again, he didn't mention, and Sean brought up a little bit about the solar project, that doesn't include revenue. And we're just putting the package together now in the budget, and there's gonna be increases in revenue also. So the town in general, and I'm not saying the town's doing great, so spend more. I'm not in favor of what Darrell said. We said, just no, go spend it. We could go save it too. We don't have to spend it. Or we can lower the mill rate, or we can do, get things we need. It's not always about spending.
Wait till we hear from your budget on increases and Board of Education about increases, and then we'll talk.
So I understand, but I wanted to say on the good side, the glass half full side, that's good news that the grand list did go up by 500,000. And I'm
Absolutely.
pretty sure we're going to get some additional revenues increases. And I think that what's on the horizon with that solar farm, and we don't want any more, the new Greystone Vineyard that's going in, Kingdom of the Hawk just came online. So the town's trending in a good way. And it's doing it with businesses that the town wants. And so I think the town's never had an appetite for box stores and malls and brick and mortar, but these kind of things are helping the town. At the same time, it's making us a little bit more fluid, and hopefully we can keep taxes down a bit and get our fleets back up to normal at the same time. All right. Is there any questions about, this might be something you want to go through and ask questions at our next meeting I think we're meeting with you again on February 7th, because on February 6th, we're going through our first go through on the regular budget. Also, I'd like to get some feedback on you from the board, if you think that maybe a small task force makes sense to look at capital, because when you get in a room with 18 or 20 people like we do at Tri-Board, it's just, we kind of run in the mud a bit. We all say the same thing, but then it goes nowhere. So if I could have, I asked my Board of Selectmen which selectmen they'd like to be on it. I was chosen as the candidate, so it's me. But if we could but I can't have two selectmen because that means we're having a meeting. It's a quorum. But if we could get two Board of Finance members and two Board of Education members, I think we could go a long way with a 5-person task force over a 3 to 4 month period, not meeting all the time, maybe bi-weekly or once a month. and then come back in September at the tri-board meeting and come up with a recommendation for the tri-board.
Bob, I have a question about can you just tell me one more time what you did with the Quint? Because I see that it's now 300,000 for 4 years starting 25. So you just inflated it and spread it out? Is that, tell me.
No, so what, originally, the original number in the 5-year plan, the chief had the new Quint down at 999,000. When we investigated that, it was really should have been closer to 1.2 million. So I don't think the 999 was a fair number to put in now, since we know it's already too low to begin with. I had the bonding on that in the Rescue One truck that we're saving for now. We saved 75,000 last year. There's 50,000 in the budget for that this year. So 125,000 would be saved if this year's budget went through. So if we switch to bonding, that would be 125,000 have to be deobligated. But I took the rescue truck, which is $1.5 million, and I took the Quint, which is $1.2 million, added them together, which is 2.7 million at 5% interest over 20 years. Averaged it out at 337,000, is it, or 335,000 per year over a 10-year period. The change I made after last night's meeting was I had it starting in 2025, 26, which is next year. But we know that the truck takes 4 years to come in, and we were told we wouldn't have to pay for it till it arrived. So why save that? Why start a bond on it now? We could save, but it's not helping us. If we're saving, it's not helping us with the budget today or for the next 4 years. But if we started a bond and we started it 4 years from now, it helps these next 4 years, because now we're just paying for the rescue truck on a bond rather than 2 trucks, and it pushes the Quint back 4 years. And those are the 2 most expensive trucks that the fire company has. Did I answer your question, Winona?
I think so. Thank you.
You're welcome. Sarah? Or did you have your hand up?
I didn't, but I actually do have a question, but I wasn't sure if we were asking a question. Hold on. I gotta find it. I noticed on the without bonding, it's page, it's the rainbow page, page 3. I saw we jumped up between column 3, so 26 to 27 is 487. 487. Sorry.
Yellow and green on it, Sarah?
Yeah, page 3 on the non-bonding.
Okay.
Non-bonding.
What line?
I'm looking at the column, so
27, 28?
oh, hold on. No. Hold on. It's really hard to see in my little phone. No, I feel like I've officially crossed over into a different category of person. I guess it doesn't, this is just the fire department one. So it looked like there might be a little bit of opportunity to spread out the cost impacts for the Quint, which I think is no, that's engine 4. What's engine 4? Is that the Quint or is that something else?
Engine 4 is just an engine. The one that says $500 on it?
500,000.
So this
Yeah.
is the one without bonding, correct?
Yeah.
So this one is the one where they're taking the ladder truck and we're saving $300,000 for 4 years to pay the $1.012 million in 4 years when it comes in. And he's also saying that engine 4, which is a 2001 truck, 25 years old in that year. So it's 500,000 he's got down for that. Is that the line you're looking at?
Yeah, it's hard for me to tell. Maybe I can look at this package later and like you said, come back with more questions, but because it's hard for me to tell, but looking at it just in a silo, it looks like we could spread it out a little bit more. So it's not 900,000 hitting in that 1 year, but I'd have to look at the larger plan, which it's hard to do on my phone. So I guess all that to say, I don't have a question at the moment.
Well, you could take that 500,000, move it 2 more years over to 29-30 year when he only has $43,000 in capital. And then you would be there. That's if that truck could last 6 years
Yeah.
from now. It's
Yeah,
2001 now, so that would put it as in that 26, 27-year-old truck at that point.
yeah, yeah. No, really nice job though, putting these two scenarios together and not a small amount of work. So thank you.
You're welcome. Thanks. Any other questions?
Go ahead. Just take me, I mean, as far as the bonding, when are, on the third sheet,
With
where's the bonding, what year is the bondings when are they
with the
happening?
bonding?
What?
The sheet with the bonding, you're saying?
Yes,
So on the third sheet, the big sheet with all the most lines on it. So the bonding starts, hang on a second. On the fire company page, which is the second sheet, okay, the fire company page. It's the one that only has the top part of the sheet. It's got
yeah,
green, brown, and yellow, basically. You can see where the bonding starts. So the first truck starts in yellow in 2025, 26 at 225,500.
yep,
I pushed the ladder truck back to 2930 because we can wait till it comes in to pay for it. So that's $337,500. But that 337,500, that also, see below there, it says above. That's including now both trucks. So now you got the last 6 years of the first truck you started back in 25, 26, and you just started a new bond for 10 years and 29, 30. So I got to have that. So those numbers are combined. So that 225 and the 337, the two trucks combined. And then at the end of 34, 35, the first truck, the rescue truck ends, and we start with engine 4, which is $135,000. And we're doing tool trucks for the next 4 years. If you understand. So everything at, like, the yellows started basically the same time, the greens at the same time, and browns at the same time, but browns, we're getting past the 20 years at this point. Because we did it as a 30-year project.
just so we have everyone on board, the bonding process, you're talking is spread over 4 years then, or spread over this time?
Bonding is spread over 10 years. So it's the first one was originally 2.7 million over 10 years, then it was a 2 million over 10 years, then a 1.5 over 10 years. Each one was 2 trucks. It just happened the 2 most expensive trucks are hitting first.
So the mechanism is we would apply to be bonded for X amount of debt that the town has incurred. And the town, the agencies will look at the town and look at the risk profile of the town, which I understand we're pretty strong financially. And they'll say, okay, we're going to issue you a bond for 10 years for this much debt, and away we go. And that's why you have it shown this way, correct?
Correct.
Okay.
That was actually one of my questions, was to ask, probably maybe even for Sean, going to the bond council and finding out, what is our current rating for the town?
Moody's rating, I don't have that. I think what Bob uses as a basis is Christine asked.
Can you guys hear Sean? Why don't you go to the, there.
Christine went to the bond council about the library project. Basically bonding $2 million for 10 years. And that's where that 5% came from. That was back in late October, I believe. Since then, the Fed rate hasn't changed. So that's probably pretty much the same rate we would get today. This being an election year, you probably will see that go down, probably, a quarter of a percent 3 times before election. And so, I mean, it will go lower. They will start to do that now that the economy is where it's at, but who knows when for certain. But that's where the bonding basis came from, I believe.
And I'm pretty sure after talking to Dan Spring many years ago about this, the undesignated fund is what they look at also, how much cash we have on hand in an undesignated fund. for our bond rating itself and to keep that as high as possible to get the best ratings, correct?
I believe that's correct. They look at your ratio of,
Debt.
Debt to, annual
Yeah.
revenue, whatever. Ways to do it, I'm sure.
Yeah, so if we, just as us as a board, we just have to be mindful when we want to start taking money out of the undesignated fund, that could affect our bond rating if we decide to go with this project, this way of financing it. So it's kind of a balancing act.
That's a perfect topic for Bob's task force.
Mike,
Go ahead.
with this, with the view of this in 24, 25, as it's presented, what's the total amount of bonding that we have to do?
Nothing for 24-25.
Or 24, 25, but it's
We're not-
reflected.
There's nothing starting in 24-20. We presented number two already for 638,436. So I'm not saying that we start the bonding now. This was an exercise to potentially start it next year.
Then when do we acquire, for example, the first 3 trucks?
Well, that's not bonding, that's financing. So what I'm asking to do on the board.
Okay,
because it-
financing, bonding, borrowing.
Okay, borrowing. So that would be immediate, that's in the $638,000 number we gave you. So those 3 trucks would be purchased once the budget was passed. To get those trucks, first have to look for the best financing we can get for those trucks, get the
Mhm.
financing going, get the trucks, and those are only 3 to 4 year
Right.
financing. It's not, and they're not $1 million trucks. They're, $200,000.
$200,000.
Yeah.
But it seems to me that what we ought to do is just have a total. The assets that we're acquiring. There should be a total that shows what we are acquiring in the capital budget. And that's not presented. So I think that's one of the things that would be recognized by the auditors, that we need to understand how much we're investing.
So I guess I don't understand, because we have trucks now. I don't know if I'm sure there's some sort of a sheet that's the value of each truck and the depreciation of each truck as we own it.
Right, but within the capital budget, we should identify how much we're going to spend in total on the assets.
But we are. It's in that bottom line number on page 2.
Isn't
No,
it
no,
pa-
no,
page,
it's not.
page, page 2?
Yeah, and I'm,
No,
you know what, maybe you missed, the financing's involved in that number. It's not taking the number.
I understand that. What,
Oh,
but we're
okay.
buying, if I'm reading this right, we're buying 3 trucks
Correct.
in 24, 25.
Mhm.
Those 3 trucks are worth $900,000.
Okay.
That doesn't show up anywhere on here.
I guess that could be a separate report. It's not, this is a budget, so I know I'm
Right.
telling you this because you know more about finance than I do.
Yeah.
But there's a budget. We've never shown that in past budgets, what the
Mhm.
value is, what we're buying. And this is the price of the truck plus the financing included in the total number. So if you took that number times, if it's a 3-year truck times 3,
Yep.
that's what the truck is worth, but there's also financing involved in that. So we've never done a budget, Lou. I'm not saying
Okay.
we couldn't,
Okay.
but, and I don't know what would be the value of that, just so I would know.
First, you'd understand how much in total assets you're acquiring. And by doing it that way, you would exclude some of these other smaller dollar amounts that would be just handled out with just a regular operating fund.
But we have so before you're on, we came up with a definition of capital. And
Mhm.
it's anything that's $10,000 or more that has a life of 5 years or more.
Right, but but that doesn't mean you would finance those over that
No,
5-year
no,
period.
there's other things on here that aren't being financed, they're just being paid for. So when you say, let's use computers, $10,000.
Right,
We're not financing computers for $10,000. We're buying computers, and we put $10,000 aside out of our budget to pay for those computers.
okay,
And not everything on this page is being financed.
okay. I just, understanding what the total assets acquired are, I think would be helpful. Because as you look out to longer term, it might be easier to identify those long-term assets, big assets that we're going to have to acquire at 5 and 10.
So would
15
it help
years
if
out.
if that was on a separate sheet, would that help?
Yes, I think it
Can
would.
I do it after I hire
No,
a
you
director
don't,
of
yeah, you don't have to
finance?
do it. I'm not asking- So it's just, okay,
I'm gonna get onto the
Just-
regular budget.
all
sooner or
right.
later. Yeah, but I think that would be helpful. If, in this year, we're acquiring this many dollars worth of assets. Does that make sense?
right, because it's going to show up in our balance sheet. Those assets will show up in our balance sheet. I mean, I haven't seen the full report, but the assets acquired will show up on the balance sheet in total. And, with the statement of cash flows on the financial statements, it'll show the entire funding to acquire them.
That might be something you want to talk to Susan about because
Okay.
it's well above me. That's gonna be, if we have a balance sheet like that, it's probably kept in QuickBooks somewhere in the accounting office. Not, well, it's not publicly, not that it's not public information, but it's not something we typically deal with.
Okay.
I think it's something that we don't track a part of the budget process itself, the value of all the vehicles, properties, and everything. I think that's a separate background that, like Bob was saying, it's in QuickBooks. The value of the properties, the value of the trucks, the value that they would be depreciating. And this is just the straight up buying. Just because we buy it at 20,000 doesn't mean the actual value is 20,000. That's, is that kind of what you're getting at? If you're buying a car for $20,000, but the actual value of the car is $30,000, well, you're getting a good deal because you're buying it for $20,000, but the value is $30,000.
And then you drive it off the lot, it's $15,000.
Yeah, and you drive it off a lot, and it's $15,000. I think that's where you're kind of going with that is the overall value of it.
Let me guess, maybe what you're trying to get, Lou, is the total of the asset of $100,000 we're gonna buy, but we're gonna pay for it over 4 years. So you wanna know the total what we're purchasing and how much it's gonna cost us over the 4 years. Is that basically what you're looking for?
Right.
Okay, so
Yeah.
that's in, and then whatever that total is minus what we're paying,
Yeah.
the extra will be paid as the interest.
It doesn't change what's acquired.
Right, we acquired it this year, it will be
Mhm.
paid for in 4 years from now.
It's
Is that
just
what you're looking for?
Right, but when we go to finance this, you're gonna be financing a much bigger dollar amount than what is represented in
No,
this capital budget.
no, the finance number is built into that.
Yeah, the finances is
Yeah.
built
Built
into
in.
these 3 right here. 1, 2, 3 are all finance, one for
But when
3
you-
years.
But when you buy the truck, will you not sign a note for the total amount of the 3 trucks acquired?
And
Yes.
if well, it depends if we buy them all at the same time from the same vendor, they could be bought, but yeah,
Assuming we
so
do.
are you asking if we are gonna buy a truck for 150,000, at the end of 4 years, it costs us 175,000? Because that's what the interest is?
No, as presented here, we're buying 3 trucks.
Hmm.
And let's just say, for simplicity, we're buying those 3 trucks on the same day. We're gonna sign a note for the total of the 3 trucks.
Using the same vendor, the same
Same-
lender?
Right, just to make it simple. So we get those 3 trucks all at once. So we're gonna have a debt equal to that total amount
Mm-hmm,
and assets that would coincide with that.
okay.
So all I'm suggesting is that whatever process we use to explain this should reflect the fact that we're acquiring that level of assets and borrowing a certain level of money. Because we're going to be acquiring greater assets, so we should reflect that. That's all.
Okay. The more information, the better.
No. Right, it just makes it, okay.
Any other questions? Michael?
I'm just. Talk to me like a 5th grader. What's the, bonding, we're borrowing money. No different than financing, but are you saying you're gonna bond $10 million over 10 years? Give me that process.
So when you're bonding it, it's almost like taking on a mortgage on the item. I'm not as familiar with bonding because I haven't done a lot of it, none in my personal life. But it's kind of like taking on a mortgage. So you're committed over 10 years with an interest rate that you're guaranteed. It's very similar to financing. It's I guess it is a form of financing, but with bonding, you can typically get a better rate. And as John mentioned, sometimes you go, a municipality can go through a state or federal agency to get a better rate.
Okay, so, and that's what I thought. So,
Typically, bonding is used on big projects, usually $1 million or more. We did bonding with the schools and the firehouse.
right,
That's what we'd probably do with the library if that came in front of us, and is also with this type of thing. But I didn't think bonding made sense on smaller trucks like at the highway garage when we could finance those and be done with those in 3 to 4 years.
right.
But this committee, if we put it together, would investigate and see if that's the best use of money.
Just so I'm clear though, on, say on fiscal year 25, 26, when we start with the rescue truck refurb, we're gonna bond all the money that we need to buy the thing, but, and it's gonna cost us 225,500 over those next,
So you're looking at the without bonding,
no, with bonding.
where are we looking? On the, what page are we looking at?
Well, I'm looking at the second page, just
The second page, and it's the fire.
the rescue
the
truck,
firehouse?
the rescue truck refurb.
So it said, unfortunately, it says refurb, because that's what it said originally.
Yeah.
That's no longer a refurb. I just forgot to. put
Right,
that.
I know, that's so,
But if you look at the one without bonding, which is the other one, where it is truly a refurb, and you'll see on the blue and white, the 8x11 sheets,
yeah,
and you look for that rescue truck refurb, 75,000 we put away last year. They're asking for 50,000 this year, 100,000 the year after, and 75,000 the year after, because that adds up to 300,000, and that's what the refurb cost.
no, I get that.
But
So
you're not
instead, we're gonna,
if
we would get a new rescue truck in 2025, 2026 by bonding.
So instead of refurbing it for 300,000, we'd be buying one over 10 years that's worth 1.5 million, but you would not be refurbing it. So you save the 300,000, but you're paying $1.5 million to bond it over 10 years.
On the. Oh. Shoot first.
I don't know. Sarah, how long have you had your hand up?
Not very long.
Go ahead.
Just a clarification, the one that's without bonding, is that only without bonding or is it without bonding and financing?
Only without bonding. So it's just with and without bonding. Financing holds the same on both. When we did the 5-year plan, which we approved the first year, we had financing in there, and we had kind of explained that why we went that route. Because of the inflation rates, the maintenance we put into the vehicle, and what we can sell the vehicle for today, the old one versus 3 to 4 years from now, that way outweighed what the finance rate would be. So we get the truck. I think even Lou mentioned at that meeting that night, why ask taxpayers for money up front for a truck we're not going to have for 3 or 4 years? And if you save, if it's a $200,000 truck and you save 50,000 a year for 3 years, now you're going to go make your last payment. And now that the trucker was 200, is now 250. So your last payment is not 50, now it's 100. Or you push it out another year and do 5 years. So it just made financial sense to take trucks that you could pay off in 3 to 4 years and do it through financing. So that's the same in both with or without bonding. The bonding was when we talked about the fire company trucks, because they're so much more expensive. And how do we handle that? And up until this point, I don't know if the town's handling it the best way. Maybe we were, but I'd like to have someone show that to me.
Yeah, I appreciate the difference of opinion. I think I made my philosophical approach very clear on my previous call, so I won't get on my soapbox about it, but I would like to see the math, because in my experience handling finances, you never come out ahead when you go into debt. So I would love to see the actual math that went behind that, in terms of how you justified that the 3 years of interest at one of the highest interest rates we've ever had is actually better for the town. And I can look at that offline, but I don't need that tonight.
I think we had, the interest rates we had were at 4.72, I think, but I'll verify that for you, and I can come up with those, the pros and the cons of why we decided to go that route.
Did you, yeah, okay, thanks.
We did
Lou?
pull actual maintenance cost. financing. It was a guess to what we could sell the truck, old truck today for versus 4 years from now. And it was also a guess on what the truck would cost 4 years from now. That was an inflation factor, which we don't know.
Yeah, and I'm just offering my personal opinion. I don't know what my fellow board members would say, but I know there was, as part of the audit, I think there's a fairly significant amount of dollars coming back from the municipal budget of somewhere around 385,000. Correct me if that's incorrect, but you know, I think there's other scenarios we could look at like buying one of those trucks this year with the additional budget that was returned and not necessarily having to wait and then spend extra money on financing by bonding all three. I just, you know, again, we lose our flexibility. We already have a we spend $1.4 million a year on financing in this town. So we're already strapping our cash. But again, I promised I wouldn't get on my soapbox, and then I kind of like stepped up, so I'm gonna step off. And I just would love to look at the math.
Thank you.
I was just gonna comment on the difference between the financing and the bonding. The bonding would be, if any bonds that we sell would be tax exempt income to holder. And that's how we get the better rate. So then the question is, whoever getting the financing from, would they also be taking advantage of tax exempt income? So that'd be a question for whoever we're getting that money from. And so then it's just a matter of term. If you're going out 4 years versus 10. So you're financing regardless. It's either a bond or just a note.
Right.
Regular note. And the big question would be, could we get a lender to accept the note as a tax exempt instrument, if that's important to them? And so most savings banks wouldn't be, but the commercial banks would be because they pay taxes.
And again, bonding isn't gonna be involved in this year's budget. It's just something we talk about for down the road.
Right.
But I think that, sounds like, Mike, you have a lot of good candidates for this task force if you want to have 2 people volunteer.
Yeah, I mean, I guess my one concern is, you know, if you're gonna bond it in year 2026 to start then, but you can't get the machine for 4 years. That's why we were talking about doing some.
Well, that's why I pushed that bond back 4 years on that particular vehicle. So
Okay.
we weren't starting it until 2029.
So how, you know, can we sign a contract for that to
Well,
get
yeah,
that
I
bond
guess if you
vehicle?
said you would order it, make a small down payment to secure the order, but then you wouldn't have to pay for the truck until it came in. So I didn't start the bonding until 4 years from
Okay,
now.
that makes sense for me now. That's what my concern was, like, why are we, you know, are we gonna be able to guarantee that we're gonna get this vehicle when the bonding starts? So, yeah, okay. Go ahead, Winona.
Thanks. So I don't think we have this number, but I'm just curious if we have the sum of row 63 for each of the 2 scenarios. Or I'm going to do it by hand, so not a big deal if that's what we need to do. It's my first question, Bob.
I don't have, you mean the variance between each year using?
No. So row 63 is like the sum of all capital with using bonding or non-bonding. I was just curious to see what the sum was to compare.
Oh, I don't have that. I'm sorry.
Oh, that's okay. I'll just add it up. Not a big deal. Okay, my second question is around the bonding. So looking at the 20-year plan, it basically looks like we're just going to have this rolling 10-year, $2 million bond, basically, right? Because where you're saying above, that's, I want to make sure I understand what the above means in this plan.
It says above, it's that I'm taking that line and the one above it in the same color that started at the same time. I'm adding those together rather than having 2 separate. I'm doing one bond for the 2 trucks rather than doing 2 separate bonds. So
Okay.
just for accounting purposes, that's what I was doing.
Okay, I understand. So thinking about, so when we sign let's just, if we sign the first bond next year, it's a 10-year bond that we're committed to at about $338,000 a year, correct?
No, if we started this next year, since I moved that.
Oh,
back,
wait.
it'd be 225,500. It
Yeah.
wouldn't be until year 5 that we would have the two combined. It's 337,500. That's why it says above.
Okay. So the total capital on the all with the bonding page, we got 638 this year, and then I think that says 823 next year. Is that right? Is that what it says? 823, 936.
Yes, it does.
Okay, so but at that point, we would be in a bond commitment. And so these 823, 773, 747, to some extent, roughly half of that would be bonded, right?
Correct.
So no matter what our revenues are, we have a bill to pay
Correct.
of roughly 300,000 that's bonded.
It's not so different than the schools or the firehouse. It's just a much smaller scale. That's all.
Right. Okay. I think I'm good. Thank you.
Thank you. And nothing's saying that bonding is the way to go, but it was when they tasked the Board of Selectmen to come up with a different way of doing capital, we looked at all ways to do it. So now at least we're talking about it. We're
Yeah.
talking about 4 different ways to do capital.
Right.
Mm.
So I guess we have this on capital, what you're paying on the bond each year. Is there a separate redemption of debt that we have that's going to be there, or is it just listed on capital?
So it's listed on capital for here, but I think if we go the bonding route, we might want to consider taking in that we've bonded for 10 years and moving it down to redemption of debt line, because now it's going to be a redemption of debt, just like the school and the firehouses. But I think for these purposes, for now, to try to understand what it means to the budget, I think this is the best way to understand it. But once we lock in, it would go down to redemption of debt. I would have to, because that's what it
Right.
would be.
Right.
It could be, I don't know, what's the term, when does debt become long-term debt versus short-term debt? Do you know that? I don't know. Lou knows that.
Anything,
When
well,
is it,
it's
when
3
short,
terms, short term, midterm, and long term.
so what's 10 years?
10 years would be a midterm.
Okay, in the school and the firehouse are long-term, I guess, so, but we say it would still be, we could still have the
Yeah.
redemption of that part of the budget. But that's a decision we can make at the time, I guess.
But if you finance for 5 years, you're still gonna have redemption. It's just the principal and interest repayment on the debt. Regardless of how you finance it, whether it's long-term.
I'm just trying to, we're going to have to eventually sell, these budgets to the taxpayers. And, where does it show up? And to your point, you have this capital item that has a value. And, is it reflected really in, people can see the school, they can see the emergency services building. They know they got something of value. I mean, these other things are not necessarily going to be visible. So,
But
Only when the lights are on.
I gotta tell you, I see every one of those trucks when they drive by my house.
As long as they don't stop.
or when they don't drive by, if they're not running and they don't drive by, that's when they'll know that, yeah, maybe we should have gotten a new truck.
So I do have one question. So if we do decide to go the bonding route, right? I believe, maybe I'm wrong, that would have to be a separate question at referendum, correct?
I'm not sure.
So you'd vote on, the school budget, you'd vote on the selectmen's budget, and then you would have bonding questions.
I could see, and Sean could help me on this, so we could see how other towns have done it. Not
I've-
always bonding doesn't always happen at budget time. I know
Yeah.
Colchester just bonded for those 3 fire trucks, and that was not during budget time. It was a separate bond issue.
I'm just thinking is that something that we're gonna have to do? Is it something, if we do decide to go like this next year, obviously next year, that's something just to
Something to think
look
about
at.
how we,
Something to look at.
obviously the best way would be the most transparent way that people know how it affects their income, how it affects the taxes, but so.
Of course. From my eyes, looking at both, you guys did an amazing job in that short period of time. Bob, Great job.
I'm thinking of quitting my job and trying to apply for the other one.
More money. But no, really, Bob, you not, with the information that you provided for 5 and 20 year out with this much detail and everything, I think the rest of it, you knocked it out of the park.
Good, thank you.
So,
Nothing, at least we got something to look at, so we can start somewhere.
yep.
Yeah.
So,
Unless
thank you.
anybody has any specific, Winona, you got a specific question?
Sorry, for someone who can't talk, I'm talking a lot. So I ran the numbers and the difference between, on the 20-year, the difference between, I'm gonna say buy versus bond is about $500,000.
In which way?
So the
Bonding?
bonding costs more by 549,000 roughly. So not immaterial, but not as significant as I might have thought 20 minutes ago.
I would
And-
guess a higher number than
And
that,
that's
too.
assumed rates, Winona. So until we know what the bond market's yielding,
I completely agree. Just row 63, the comparison between row 63 on each of those files is 549,000.
Thank you for
Thank you
doing
for
that.
that.
We all set, Mike?
Yeah, I think we've definitely gone over this enough tonight. Thank you so much, Bob, and the rest of the selectmen.
When I
uh,
see you
for-
next week when we get together, 3 chairmen, if you could let me know if you guys want to put 2 people forward and just maybe have that, not during budget season, but maybe after budget season ends and something we can do and be ready for maybe a September tri-board meeting to talk to the entire group.
I think that's a really good suggestion, and
Thank you.
there might be some other people that we could pull into that little ad hoc committee. Treasurer, maybe Dan Spring.
so just using the assumed flat, I just want to point something out, and we're getting in the right zip code in my mind. Assuming that the levelized one and the bonded approach is about where we land when the dust settles, whether we bond or not. Against the $6,715,000 total budget, that's capital, operating budget, and redemption of debt for the town, that puts the capital at about 12% of the budget. Which feels about where it should be. But we got a little bit more work to do, but thank you. I mean, this was a huge lift. I think we're in a much better spot just taking a long look.
I'm happy with that.
Great job, guys.
Okay, we had 2 different minutes to review. December 6th, 2023. I think that one was before that, right? Yeah, November 15th.
Can we approve them both at once?
Yep.
I make a motion, we approve both sets of minutes as submitted.
Second.
Any discussion? All those in favor, say aye. Aye. Any opposed? Yeah, you can abstain. I think, were you at the second one? No. Okay. Motion carries. Thank you, Amy. Public comment. Anyone online?
Amy, did you cut your cable or something? Okay. No, I wasn't sure if you were being shy. Oh, yeah, it's riveting.
If I had to listen to an audit presentation every time, I would quit. Just so you know. Just tell me, is there anything wrong? Yeah, right. Sean, go ahead.
I just want to thank you for bringing up the topic of reflecting debt in the redemption of debt schedule instead of the capital budget. You may recall a number of times, probably at least once in the last 6 years, that I've argued that point to you folks about putting it in the right place. And I think it's finally sinking in, and it allows you to see total debt in one place instead of hiding it in the capital budget. And there's some things in the capital budget now, town hall maintenance, are you gonna rethink some of these things and move that into the operating budget? There's some, turnout gear. I mean, are we really making, we're not really making improvements when we're doing town hall maintenance. We're repairing roofs or whatever. We're not improving on a capital asset. I mean, is this going to be considered for movement into the operating budget versus capital?
Which one, Sean, specifically?
Town building maintenance, 1750 farmhouse repairs, flyover and mapping, turnout gear, for instance. I think that all, Sean, should come out of the task force because there's got to be a tighter definition as to what creates a capital asset.
Yeah,
So if it's a life extension for a town building or asset, then yes, it should be capital. If it's maintenance like paint or repair or glazing or whatever, then that should be maintenance. But I mean, we're taking baby steps here. We can't fix everything at once.
I think, the computers is another example where $1,200 computer probably at the most is being, showing up in the capital budget. Just while you were making changes to it, those are just other things to consider.
Yep.
Thank you.
Thank you, Sean.
Mike, sorry, I have a request that the March 18th meeting, which would be a special meeting for us, be a hybrid meeting, so that I can join remotely. I did check how we handled this last March, and all of our Monday meetings, which were special meetings, were hybrid options.
I don't have a problem with that. I think it allows people to participate when they don't feel well or can't make it for whatever scheduling problems. As far as I'm concerned, is if everyone wants every meeting to be hybrid, and then, we just have to list that in our agenda.
Sometimes our special meetings are not hybrid, so I wanted to bring that one up as a special request just to get it on the table.
I don't remember a meeting outside of the tri-board meetings that weren't hybrid. I could be misremembering, but I thought all our meetings were always hybrid. Or if they weren't, they should be. I agree with.
We don't have a meeting on the 31st? No, of January. That's just like, it's not, we have the 17th and next week's the 24th, then it's the 31st.
Yeah, we don't start more meetings until March.
Yeah, they're not always every other week. I think this is one where it's twice a month and we just have Wednesday.
All right, so I'm gonna have to reconfigure all these on my own calendar.
It was the first and third Wednesday, except in March when we just meet a lot.
All right, I'll just have to reschedule this. So we have meeting the next meeting is February 7th. Motion to adjourn.
Second.